Learn the art of investing on Moneywise.
Welcome to the Moneywise Podcast, presented by Bandhan Mutual Fund. I'm Ritama, your host, bringing you expert insights on finance and investing. Market volatility can be unsettling. Panic selling, impulse buys, and costly mistakes. But how do you stay ahead in uncertain times? Joining us today is Chetan Agarwal, Head of Treasury at Bennett Coleman and Co, managing multi-billion rupee portfolios, a chartered accountant by profession with 25 plus years of expertise in treasury, investment, and risk management. He's here to share what not to do when markets get rough and how to make smarter financial moves instead. Chetan, welcome to the Moneywise Podcast, and how are you doing today?
Thank you, Ritma. I'm fine. Looking forward for a fruitful discussion with you.
Thank you so much for joining us on this podcast. So without any further ado, let's jump into the questions. So Chetan, you've had an incredible career in finance. And over the years, what's one lesson or philosophy you've learned about markets and investing that continues to resonate with you today?
One of the lessons that I have learned in my investment journey and in my professional journey is that one has to be disciplined. When it comes to investing, I think discipline always wins over emotion. So, looking at the market, people many a times, miss the discipline path and get the emotions take over. But I think discipline is one thing which pays off in the long run to any investment.
That's a great perspective. So Chetan, market volatility can be confusing, especially for new investors. In your experience, how would you explain volatility in simple terms? And why is it crucial for investors to understand its impact?
So, according to me, volatility is a normal part of investing. People normally get scared when the markets are volatile, but people tend to forget that it is like any other factor, be it economic data or interest rates. So, it's all driven by these factors. So, volatility is part of investing and has to be taken in one stride. And these are those times when investors can really make money. People tend to forget that volatility can cause losses. I mean, people generally feel that volatility can cause losses, but these are the times when one can actually look at their portfolios, build their portfolios, and volatility, according to me, pays off in the long run. So it's part of the investment journey, I would say.
Wow, that makes perfect sense actually.
Sure.
Just like we prepare for a bad weather, investors should always be prepared for a market fluctuation instead of reacting emotionally.
Hmm.
So moving on to the next question.
Sure.
We often see investors panic when markets dip. They sell at a loss, buy at the wrong time, or follow trends blindly. So what are some of the most common mistakes you have seen investors make during volatile times? And how can they avoid falling into that trap?
Most of the common behavior that you see in these times, especially when the market is down, is panic selling. And exactly opposite that we do when the markets are higher. We have that fear of missing out and we tend to invest when the markets are at the peak. So as I mentioned in the beginning, you have to be disciplined. You can't time the market. Investment, according to me, is more of a behavior management than, anything else. So one should avoid all these kind of behavior, whether it is panic selling during the correction of the market or having a FOMO, when the market is at its peak. So both these extremes should be avoided. Okay. So one should have to avoid these mistakes. One can have few check boxes. So one of them would be, say, you have a plan, right? So anything that you do, you stick to it. Don't just shift the goalpost when the markets turn. So have a plan, stick to it, focus on fundamentals, and don't look at the headlines, because headlines basically tend to give you what's happening in the short term. But when you have decided to invest for long term, I think we should stick to the fundamentals. And as I mentioned, volatility should be used for as an opportunity, I would say. Right now, if the markets have corrected 20-30%, many stocks are available cheap. So one should try to build their portfolios rather than getting into a panic selling mode and thinking that everything is going to end and FDs or those kind of products will be better. So all those emotions try to control us in such situation. So we should use these volatilities to strengthen our portfolio. These are buying opportunities, and at the same time we can diversify. If you are, say, somebody is heavy on debt or any other real estate, and when you see such corrections in the market, one should try to diversify. Many people, they sit on the fence thinking that correction would come, but when actually the correction come, nobody buys. So I think this situation, people should diversify the portfolio and also rebalance. If you are high on debt, try to take some equity exposure and balance it out. Similarly, when the equity markets are at peak, try to book some profit and shift to that debt. So in this way, you can rebalance your portfolio.
That's such an important reminder for the listeners out there. Thank you so much for sharing that with us. So, Chetan, one of the best ways to manage risk is through asset allocation.
Yeah.
So, could you please break it down? Why is it so important and share a simple approach
Yeah.
to balancing out one's portfolio during uncertain times?
So asset allocation is one of the most powerful tools to manage risk in such volatile times. You are not heavy on any particular asset because different assets behave differently in different market situations. Okay. So suppose somebody is very heavy on equity and the market corrects, you kind of panic. But if your portfolio is well diversified, then other asset class would do well. Say you're invested in gold, and when the equity markets are correcting, gold is doing well. So that way you are balancing your risk across different asset classes. So I think one simple approach that one can follow in uncertain time is that you first know your risk tolerance. Okay. People many a times go overboard. They invest heavily into equity and then they kind of surrender to such panic selling. But one should know their risk tolerance, how much risk I can take, and accordingly plan their investments. Diversification, I have already mentioned. Rebalance, as I already mentioned, that in such situation the market has corrected. Try to rebalance your portfolio. If you're heavy on debt, put some money in equity. If you're heavy on, say, gold or real estate, you can put some money in equity and rebalance this. And having said all this, I think one should always keep some emergency fund with himself or herself to take care of any untoward incidents, which happens. So we had COVID, COVID, nobody predicted COVID and everybody was taken by surprise. So, I mean, I'm not saying that COVID is going to happen again, but something of some sort which will disturb your life, your cash flows. So you keep some emergency fund for that.
Well, that really puts things into perspective here.
Yeah.
Spreading risk instead of putting all your eggs in one basket is a bad idea.
Yeah.
But even with the right mix, it still takes patience and discipline, doesn't it?
Yes.
So let's talk about that next.
Sure.
So, Chetan, patience and discipline, these two words come frequently in investment discussions. But why are they so crucial in navigating a volatile market? And are there any strategies or habit that can help investors stay grounded?
See, patience and discipline are everything while navigating in a volatile market. Okay. So strategies for this is one, stick to your plan. Okay. Focus on what you can control. Like many times we try to control things which are beyond our control. What's happening in the US, what's happening in the Gulf, what's happening to oil. We can't control those things, right? So we should try to focus on what is under our control. Okay, like rebalancing the portfolio, diversification, rebalancing, those kind of strategy which are under our control, you should try to focus on. And we should then also try to zoom out and see what's happening. I mean, if we get into micros, then you kind of panic. Okay, you will feel everything is going down. But just zoom out and see what is happening, what has happened in the history when such situation has, I mean, we have come across such situation and what has happened after that. So that will kind of stop you from panic selling or overbuying. And one of the things that investors normally do in both these situations is that they keep checking their portfolio too often. So when the market is peak, everybody is happy and they'll see the portfolio. When the market is down, they'll panic and see the portfolio again and again. So that one should avoid. Because if you have a long-term investor, there is no reason for you to see your portfolio again and again. It's like planting a tree, right? When you plant a tree, we don't go and see every day whether the fruits whether it's bearing fruit or not. It takes time. So I think one should be patient and yeah, I think that's it. That's few checkpoints and many points we have already covered. Turning the volatility into opportunity, staying focused on for your goals. So one should focus on these check boxes.
That's a fantastic way to put it, actually. Staying the course isn't easy always, but history has shown that disciplined investors are the ones who succeed.
Yes.
And that ties into another common debate, that should you time the market or focus on time in the market? So, Chetan, buy low, sell high, that's the dream, right? But markets timing is tricky and often backfires. Can you please elaborate on why time in the market is usually a better approach than trying to time in the market?
Uh, Absolutely. So timing the market is like predicting something which is not under your control, right? So it's extremely difficult, even for professionals. Even I mean, the biggest of the fund managers many times get it wrong. But what they get it right is staying invested, which is time in the market. So historically, also the most reliable way to build wealth has been time in the market, which is staying invested for long, right? And by time in the market wins over timing the market is because all of us know market timing is nearly impossible. Nobody knows the peak, nobody knows the bottom. If one knew this, I think they all be gods. So, and another reason time in the market is important is because the compounding, the magic of compounding that we have been hearing works well when you stay invested for long. Because markets have been volatile. So, in a year, you may get, say, double digit, triple digit returns also. But next year, you might end up with a negative return. So, to kind of average it, you have to stay invested for long, which you will not be able to do by timing the market. So staying invested will allow you to compound your wealth. And many times it may so happen that you exit, okay, and next day the markets go up, which eventually happens with all of us. We try to sell something and next day that thing goes up. So we may miss out best days by timing the market. And long term always favors the investor. So staying invested for long term has paid off. So I think one of the research which was done, kind of showed that two category of investors made money. One who invested and forgot, and another category was the investors who invested and died. So basically, nobody knew they had invested that money, but which in a way shows that if you stay invested for long, you can trade huge wealth. And another simple strategy for time in the market would be doing your SIPs, your STPs regularly, because there your emotions are not coming into play. That kind of is like a rupee cost averaging. You average your entry points. So because many times people decide, okay, I'll invest when the market corrects, and they miss out. So people have lost more money waiting for correction than the actual correction happening. So one has to invest regularly without your emotions coming into play. SIPs are a beautiful SIPs is a beautiful product where people without looking at where the market is continue to invest, and that has paid off in the long run. And another strategy is you need to be diversified, and one need to think into decades, not in days. So yeah,
That's a key takeaway, actually. Let compounding do its magic instead of chasing quick gains.
yes.
Now, before we wrap up, let's leave our listeners with some timeless advice. So, Chetan, if you could distill your experience into three timeless principles or pieces of advice for anyone looking to build a strong, resilient financial foundation, what would they be?
Mm, this is a good question. I think three timeless principle which I would recommend to the investors are: be disciplined. Okay. Automate your investment. I mean, when I say be disciplined, you have to automate your investment through strategies like SIP, STP, which allows you to be disciplined regardless of the market volatility. Second principle is diversification, which is your best risk management tool. Spread your investments across stocks, bonds, real estate, gold, Emergency fund I mentioned, because that also kind of is a diversification for taking care of any untoward incidents. So that this kind of diversification will help you, achieve risk-adjusted returns. And last but not the least is think long term and stay the course.
Chetan, that was brilliant and it was an insightful discussion today. A big thank you to you for sharing your expertise and breaking down the common investing mistakes people make during volatile markets. And more importantly, how to avoid them. If there is one key lesson from today's conversation I've got, it's this: that volatility is inevitable, but smart investing is all about patience, discipline, and asset allocation. Remember, wealth isn't built overnight, it's a journey.
You're listening to Moneywise, brought to you by Bandhan Mutual Fund. Check out the rest of our series for more insights on investment and personal finance. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.